Hey everybody, how you doing? Welcome back to the Calvary Realty podcast. I am your host, Brandon Robinson, president and broker of Calvary Realty, Inc. And I have a very special guest with me today that's going to help us get some financing for our next self-storage purchase. We have the man, the myth, the legend, Mr. Andy Graham. How you doing, Mr. Graham?
I'm well, thanks, Brandon. I don't know about the legend.
No, you are. I've heard many great things about you. I've heard that you were able to finance deals that no one else was able to finance. That's legendary status.
So yeah, I guess so. You know, as you get older in your career, the easy ones they're easy, so you take them, but they're not as fun as the ones that you have to really think a bit, go,
Right. Yeah. You have to problem solve, right?
Yeah, right.
Yeah. And that, you know what, that's why you're here. You're going to help us problem solve, help us do what we need to do to purchase our next storage. So
that is the fun of it.
It is. So before we get started, can you just give us a brief overview of your time in the industry? Just give us some brief background summary about yourself.
I got started in the 80s and I fell into mortgage banking, which is what I've been doing now for, 30 years by accident. So I started in Union Bank's training program to be a banker. I went through that. And met a guy in the mortgage banking department by accident because everybody was doing real estate and I hadn't really been exposed to that yet. And part of your training, you can go into that various departments and get some experience while you're doing the other training that they're doing. And I really liked real estate because it's a nice mix of actual physical, where you see the asset and you can change the asset physically, and yet still the intangible, the finance stuff. And it was a really cool mix. So right. I ended up going to work for that department after training at Union Bank. And they opened a San Diego office. I don't know how I talked them into that. So I went down and worked in the real estate construction department, but I was the mortgage banking department all by myself, 20 some years old.
Wow.
And I got my shins kicked for probably 3 or 4 years, started to figure it out. I had a terrific boss who's legendary in the business, a guy by the name of Lou Hastings, who taught me everything I know. So I did
that's
that
where your
for a
legendary
decade.
status comes from, right?
I'm sorry?
You're a legend because you learned from a legend.
Yeah, that's true. Many people know him. He's a great guy. After a while, I sort of got tired of having only one tool, and I joined a friend and partner to go back into mortgage banking in 2000 as an independent mortgage banker, and have been doing that ever since. And in 2014, we became the San Diego office of the Allison Company. So we own the San Diego office and work with the guy. We're headquartered in Orange County, the principal's up there. So that's the short and sweet.
Nice.
I think one thing that's really helped me that would describe sort of my career is I've been both a lender inside the institution where you collect the data, do the write-up, present it to committee, use your closing department with our own money. And then I've also been a broker on the outside. So I've switched on both sides of the fence,
right,
which has been really helpful as I work with lenders. And then I'll take my white hat off, I'll put the black hat on, and then I'll be a broker and I'll be sort of on the borrower side. So I figured out over time by accident, I can speak both languages really well.
Right.
And that's been really helpful to getting deals done with lenders. And also, being an entrepreneur for the last 20 some years, I know the world that the borrowers live in, which is not regulated and not with committees or any of that stuff.
Right. So at Allison Mortgage, are you saying that you lend money, Allison Mortgage's money, but then you also can broker?
No.
Okay.
So Allison Mortgage is a mortgage banking firm or mortgage broker.
Okay.
They're kind of the same. They're used. They're swapped together, but we're a mortgage. Allison Company is a mortgage banker in that we have, I don't know if it's 13 or 15 life insurance company and some other correspondents that we're literally signed up. We service the loans. We do inspections every year, and we have some form of exclusive or semi-exclusive ability to represent these life companies.
Got it.
Symetra Life, Standard Insurance, RiverSource Life, Woodman of the World, Southern Farm, etc.
Got it. Okay.
And then we also broker. The business these days is such that everybody does both. We broker, which would mean we don't have any official correspondent relationship to other life companies, credit unions, banks. So we're an intermediary. We don't lend Allison funds.
Gotcha. Okay. Got it. All right. Well, let's move on and talk about self-storage facilities. So what are some of the common products that you guys have for buyers that are looking to get financing on self-storage purchases?
Sure. In fact, and this will sort of dovetail from the last question, that so my job is I'm not the bank, I'm not the loan officer, I don't decline deals. Right. My client would be the borrower, and my job is to find a solution to their need or problem. I don't know if we want to call it problem. The tools we use would be life companies, which are really good at long-term fixed,
right,
non-recourse. They tend to want cleaner properties with less issues. We'll use banks and credit unions, which can take more unusual situations. Usually, they'll come with recourse, and they can't get quite as long fixed. Maybe 10 years being about the maximum.
Okay.
CMBS is a acronym for commercial mortgage-backed securities. That's Wall Street funds. That's where your loan goes into a pool of mortgages. It's sold as securities.
Is it kind of like hedge fund? Is like hedge fund, or
that's not a hedge fund, but it's like that. So Morgan Stanley,
right?
A lot of Wall Street firms. Bank of America has a CMBS fund. Ladder Capital is one that we use. They do certain things really well, but then they come with a lot of. You'll find every lender type has its good side and downside. So
yeah,
there's no lender that has the best rate. It's non-recourse, interest only, the maximum leverage.
Yeah,
that doesn't happen. So it's more like finding what's most important to the client. Usually we like to, if the client will organize their priorities, like this is my number one priority, this is number two, and this is number three, which type of lender they use or loan program starts to become clear really quickly.
Okay.
So that helps.
So what if you have let's say we have, I'll give you a couple different scenarios. Let's say we have a property that it's stabilized asset, and let's say it's a Class B or Class C property, pretty decent construction, metal and concrete. So, nice Class A or Class B property. What would be and it's stabilized, what would be the ideal lender or ideal program for a property like that?
That would have quite a wide window of what the client wants. So
okay,
we could use life companies will usually offer the lowest rates,
right,
and the longest rates. More often, life companies come with some sort of prepayment penalty or more of a prepayment penalty. And so it would depend then on the client. Do they need to sell? Are they going to own this 5 years, or do they like to is there something about the property they would change where in middle term they would want to reposition or sell it or refinance it?
Right.
Those kind of questions would depend on, we would match the prepayment penalty up with the answers to that.
Gotcha.
Some clients, they just want to buy it, put a debt on it, and manage the heck out of it and put it on the shelf. And that's really good for life companies.
Okay.
That would also fit though for banks. We could do 5, 7, 10-year rates with a bank. And those also have prepayment penalties, usually less so, or some declining ability. So like if they woke up in year 6 and got an amazing offer and wanted to sell it, they would be less encumbered and could do that and pay off the loan without penalties or very few. So
I got you.
So that property you described has a lot of solutions that depend less on the property and more on what the borrower's thinking.
Right. Yeah. Okay. I got you. What about a situation where, let's say, because I sell a lot of value add deals where, they're pigs,
Yep.
and I put lipstick on them, some makeup, make them look pretty. And, so what about a deal where, okay, it's mismanaged, there's a lot of value add, it's only 50% occupied, but the market is, say, 90%, and there's some, there's a little bit of deferred maintenance, which, you have to spend a couple $100,000 to spruce it up. So what would be, I guess, an ideal lending scenario for that?
That sounds like a deal all our clients are looking for, doesn't it?
Yep, exactly. Yep. Probably 80% of the people are looking for that.
Those are hard to find.
Yeah.
There are some life companies that will do unstabilized, let's call that, properties, but more often that would be a bank or somebody that's flexible. So in a scenario like that, you're sort of choosing between one loan that would last you for a while, which would generally be a little less leverage, and or the alternative would be a loan that would really see where you're going after you reposition it, and it would be more aggressive. But typically with those loans, pricing would not be something you want to live with too long past the time that you've dressed up the property. Right. So then what would happen is it would get you in, let you buy it, and then a year or two or three, you're going to refinance it. So then again, it comes back to the borrower's choice of if they have enough to put down and rates are good and they just want to get a loan at some amount of leverage, 50% or something, we'd go in one direction. But if they wanted to get aggressive leverage, we'd go in a different direction. Pricing would be such that, that would be a loan with a bank or one of our credit unions that would have ability to lend more on the value add, do an earn out, stuff like that. But the rate would be such that you could replace it with a better rate once it's stabilized.
I got you.
So I don't know if I answered the question well, but
no, I see what you're saying. So if you're buying a value add property, you can leverage it and get financing, but it's probably going to be at a little bit higher interest rate than if you have a stabilized,
correct,
cream in the crop type asset.
It wouldn't be a loan you want to live with for, say, 10 years, but
just something to get you into the property.
I'm sorry?
It's really a loan to get you into the property, do what you need to do, refinance it 3 years later after you've improved the property and the income, etc.
Yeah.
I got you. Okay. What does the down payment determine which product, whether or not you go with a life insurance company or a traditional bank? Does that determine which product you would choose for a client?
That's a good question, which brings up a possible another product type. Most commercial lenders, conventional we'll call them, have loan to values that will range between 50-60% for some life companies to 70% is sort of the main, sometimes 75, but it's not just a loan to value. So coming up with a leverage is not just stamping the loan to value on it. All the lenders will look at debt coverage, meaning that your NOI will pay for so much debt service. And there's a 120 debt coverage with a 20% difference between the, and that will limit loan to values depending on rates and NOI. Where was I going?
So with that debt question, with the debt coverage ratio, that if I'm thinking about this right, so like if you have a debt coverage ratio where you guys want a DCR of 120, that means that the net income has to be like 1.2
120%.
120% higher than the debt service. So if the debt service is say 100,000, the NOI has to be at 120,000.
Correct. And so for the lender, what that does is there can be some amount of loss or change in the income, 20%, before you go below break even. So the lender wants the borrower to have some margin so that, you know, they're not having to come out of pocket for the mortgage. The property pays for itself. That's correct. That makes sense. Sort of what their goal is, and that's what the debt coverage ratio is. So sort of going beyond that is one of the more aggressive leverage types comes from the SBA programs.
Oh yeah.
Where they'll go up to 80, 90% of a purchase price. They're not unconcerned with debt coverage, but they can go as low as 105, 110 on a debt coverage.
Wow.
We do less of those. There's two types of SBA programs. One's called the 504, which has a first trust deed from the lender of 50%, and then a second trust deed from the SBA of 35 to 40% with their own rate. And then the other type that it's called a 7A, and that is just one loan from the actual lender, and then the SBA guarantees for that lender part of the loan.
I got you. Yeah, I haven't done many of those. I've done the SBA 504 for a lot of deals. The SBA 504. Then there's one I think it's SBA 504 Green, right, where they give you some type of incentive for energy efficiency, putting on solar, that type of stuff. So I've done those. Those are some long escrows, man. Those are like 120 day.
Yeah, right. It sounds great. Everybody wants leverage, and the rates for the 504 tend to be pretty good, but it is a cumbersome, difficult process. It doesn't usually it's hard to marry the SBA program to a market purchase right now, as you probably know. Sellers won't put up with the amount of time and headache it takes.
Sorry, I cut you. I think you were talking about you were talking about the SBA 7A before I cut you off.
Well, the 7A tends to be a little more expensive, either prime based or maybe 5-year fixed. The 504 can be more like 10 years fixed comes from the first trustee lender, and then the SBA rate is a 20-year fixed, fully amortizing. So in short, that's the program. We don't do as many of those because a lot of our clients, the properties they're trying to find are difficult to fit into the time and the paperwork headache to get through the SBA.
And it's hard to make, you got to find the right deal because it's hard to make that cash flow. You know, if you're buying something that's, and you're leveraging 90%, you got to really have some good cash flow. Yeah. What are the rates on those right now for the 504 and the 7A? What's the interest rates right now?
That's a good question. I don't know.
Okay.
Partly I don't know is because the world has changed a lot since March, as you know, and we don't do as much SBA, so it's been a while since I've checked in. But what clients probably already know, or borrowers already know, is we've seen treasuries go, I don't know where they were on the low. I could look this up. 10-year treasury is 273, I think I saw this morning.
Okay.
It was as high as 3. Here we go. But this is up about 100 to 120 basis points from January. So we've seen quite a rise in treasuries. You know, we were doing self-storage loans with 10 years fixed in the 3s.
Yeah.
Last year,
last year and the year before.
Last year. And now the 3s are kind of gone for anything. Doesn't matter if you're borrowing 10 million on the most beautiful property at Los Angeles downtown. The rates are sort of around low to mid 4s.
Yeah.
And then conventional or otherwise. And then as you get sort of out into ancillary or more difficult properties, mid 4s to 5s or low around 5.
Yeah, like if you're out in the middle of the desert, Imperial County, up in the high desert, you're probably going to be in the low 5s.
And it really depends. You're not, so I'll sound kind of wishy-washy maybe, but there is no one way to skin any cat, that is for sure.
Right.
It really depends on what the property, we sort of work around the challenges provided by the property, and then and overlay that with the goals of what the client is trying to do as far as their purchase and what they want from a loan.
Right.
And that kind of ends up with a maze that we walk through to end up with a solution or two. So it really depends on what the client's looking for, what leverage they can put up with.
I gotcha. Okay. So what's the typical, so I know with SBA, you're looking at, if you're doing a 504 program, you can get as much as, not 85, 90% loan to value. What's the typical, loan to value for, most of your, your most common storage loans? How much is someone looking to put down and how much can they get financed?
Yep. I would say typically we're aiming for like the typical conventional deal, 60 to 65%.
Yep.
In the 60s. We can push that sometimes up to 70. Certain properties are problematic. Clients are happy with 50%. So somewhere between 50 to 70% is where we end up almost all the time. Aiming for, say, 65 is a nice
right. So that's
typical number. You can usually fit the debt coverage you want. You can get most lenders to reach up to that number no matter what. So that's really common. And then it just depends on how much challenges are in the transaction or how unstabilized it might be.
Got it. Could that change if there's some, let's say, immediate value add? Like, let's say, there's a deal and, the debt coverage ratio on the current deal is at 1.25, but the rents are 50% below market. The guy can come in and jack up the rents and immediately, increase his income by another 30, 40%. In a
couple ways.
Yeah. Yeah.
We could do some lenders will do an earn out. So what they'll do is in a year or 18 months, as that income's changed, they will give you an additional funding, usually at whatever rate at the time. So at that time, so you'll have the money that you went in to purchase, you'll have an earn out amount that would come later after you've changed the income.
Okay.
And so that's one way. There are more aggressive lenders, as we talked about, that will lend based on the target that you're going to change to. Those programs, though, are not as stabilized or long-term. So to be specific, let's say you're buying a property that's 50% of market rents. It's not going to debt cover at 65% leverage, right?
Right.
So you're not going to get 65% leverage, 10 years fixed at 3.75 with a 30-year amortization. Because lenders want to lend where they want to lend on existing income in place.
Yep.
So you could tell them, this is where I'm going. They're like, great. Call me when it's at that leverage,
exactly.
and we'll give you the leverage. Call me at that income.
All right.
So they want to lend on income in place. Some lenders, like we can get interim loans or value add loans where they will lend based on where you're going, but it'll be, 3 years fixed or some amount of short term where they'll either fund later or you'll have reserves that pay for the difference between the income. And they'll check on it when you get there. So there's they get in your hair about that part.
Okay. Is there a name for that loan, or is it just a value add loan? Like, is there a certain?
We call it an interim loan because it's interim between when you purchase it and when the property's stabilized and you realize the value.
Okay.
There's another name like bridge lending.
Yep.
There's a lot of that, and there's tons of bridge programs.
But those interest rates are probably maybe like a percentage or two higher than like
they're expensive
on the market. Yeah.
And they're also fast. So the bridge lenders, might lend now between 6 and 7 or 8%. I'm looking at one right now for a property where the borrower has to put up $1 million hard in 30 days.
Yeah.
And they have to close like 20 days after that. And there's no ifs, ands, or buts. If they're not on that time lane, and right now we're having trouble getting appraisers are so busy.
Yep.
We're having a hard time crunching that in with like a bank lender, and the opportunity they'll miss if they don't. So in that scenario, a bridge lender who's not an institution, they might pay 6% and get 50, 60% leverage, because without that, they're not going to own the property. So it's worth it.
Right. That makes sense. Okay.
So that's you only go there if you have to.
Right. That makes sense. Are there any type of rehab loans out there? Like, let's say there's a storage property and it's in a good area where storage is really booming, but this specific property was just run into the ground. It's beat up. Maybe there was a fire or some type of natural disaster. Is there any type of loan someone could get to buy the property, rehab it, or would that just fall into, an interim or a bridge loan?
Yeah, same.
Okay.
Same.
All right.
I mean, you'll find that as far as loan description type, there's not really categories so much. There's different types of lenders that have different characteristics, what they're seeking, but most of the lenders that would do sort of an interim loan on an unstabilized property will listen to the story. So
yeah, I got
it's really important to, hopefully I'm being helpful. Most lenders are looking at, 4 different things.
Okay.
And we sort of see it like you have to have almost 3 things to have the pedestal stand up, right? So the 4 things are typically more like location, where is it, and the property, the details or specifics of the property, the borrower, are they financially strong? How's their credit? What's their experience?
Yeah.
And then lastly, the income and the underwriting from the property.
Got it.
And you can be deficient in 1 or 2 of those 4 things to some degree. But if you get deficient in like 3 of them, or there's nothing to stand up, and you can't waltz into committee with a nice write-up and picture committee, all these cigar smoking guys, or maybe women even. And
yep.
Right. And they live in a totally different world than the borrower. The borrower is entrepreneurial, and to get 3 or 4% money, that money comes from a committee that's protecting depositor money. Correct. With write-ups and regulators. And so it's very systematic, and they're reviewing something, and you're talking them into, why should we put out our money at 4% for 10 years on this property? It has to be really solid and good reasons, well written down and documented in a write-up with appraisals.
Yeah.
And that's where the 3 or 4% money comes from.
I
always like to say, because borrowers get frustrated at these lenders that are so stupid and conservative and ask all these negative questions.
Yep.
But if you're a lender and you're putting out 4.5% for 10 years, that's the max revenue that you're going to get. Your return is 4.5%. And it only goes down if something happens.
Right. So they're looking at worst case. They have to look at the worst case scenario to protect their borrower.
All they get is 4.5%. Never gets better. So borrowers are in a totally different world. 4.5% is cheap. They're looking into the teens, and they're totally so the lenders live in this world, and the borrowers have this world, and they overlap And all the deals are done in that little space in the middle.
Right.
They talk different languages. One's talking German, the other's French, right? And so we sort of interpret, and all the deals are done in that little spot.
Yeah.
And it's just totally different world. So, and a lot of the lenders don't understand, or the good ones do understand, but you know, the borrowing world, you know, we always like to say, sort of, or another analogy is fun is, you know, when you're getting a loan, it's like dressing up for church on Sunday. You take a shower, you put on some nice clothes, you know, and
come
but
looking
we
your
know
best.
that they don't live like that all year round, right?
Correct.
So
So
to
you're out being
operate
sinful the rest of
properties,
the week, but on Sunday you come in looking nice, holy.
That's it. Clean it up, polish it up, get the garbage away, and you know, the lender will come do the tour. We're all good. We get our write-up and pictures, we go into committee, we get our loan, but we know that they don't live like that, operating that property all day, all the time, because they're in you got to fix stuff, right? And it's a different world.
Yeah. So I was writing this down. So the 4 things that you said that the lenders are looking for. You said location. You said the specifics about the property. You said the borrower, you know, their history and how strong they are financially. What was the last
underwriting?
One? Underwriting. That's what. Underwriting. Okay.
So, and that's sort of like cash flow, loan to value, debt service. And
I got you.
And almost all deals are made in those combinations. So you could have a super low loan to value, great borrower, and the property's in Blythe.
What's wrong with Blythe, man?
And nothing against Blythe, but because there's people living there and business going on. But a lot of lenders are, and this is how it is. They have nothing against Blythe, but you're lending across the country, and the lenders will have parameters like this. Like, we don't lend in